Hello, everyone. Welcome to today's webinar about financial statements and decision making. My name is Gretchen Ruthling, and I'm glad to have you with us today. I'm the Vice President of Partnerships and Development for Accion Opportunity Fund, a nonprofit national organization that provides affordable loan capital, as well as wraparound business resources to small business owners across the country, with a specific focus on entrepreneurs of color and women entrepreneurs. Before I introduce today's speakers and we begin our conversation, I want to quickly go over a few housekeeping items. First, you should be able to view our presentation through the Zoom webinar tools window on your desktop if you joined us by computer. Next, you will see a chat function in the Zoom window's black toolbar. Please use the chat button to type any questions you may have throughout the presentation. I will administer a question and answer session following our discussion based on the questions typed in the chat window. We will be recording today's webinar, so you may refer back to the information presented today at a later time. I will send an email containing a link to the recording shortly within the next few days. Lastly, when the webinar concludes, you'll be prompted to complete a very short 4-question survey about today's presentation. We really value your feedback, so please do just take a couple of minutes to give us your thoughts on the webinar. Today's discussion includes not only an overview of 3 financial documents that are critical to your business, but also real-life insights and examples of how these financial statements can make all the difference to your business's operations and growth. Accion Opportunity Fund is proud to support entrepreneurs through educational opportunities like this webinar, and we are very grateful to our partners at Fifth Third Bank for sharing our commitment to small businesses. Before we dive into our discussion, I'm pleased to introduce Philip Henry from Fifth Third Bank, who will share a bit more about the bank's commitment to the community. Thanks for being with us, Philip.
Thank you, Gretchen. And good afternoon, everyone. I am Philip Henry, Corporate Social Responsibility Manager for Fifth Third Bank. And once again, thank you for joining today's webinar, Use Financial Statements to Make Strong Business Decisions, our second small business webinar of 2021 in partnership with Accion Opportunity Fund. Our commitment to put business customers at the center of everything that we do is a driving force behind our ongoing collaboration and partnership with Accion Opportunity Fund. Together, we share a common goal, and that's helping entrepreneurs overcome barriers and achieve business growth by expanding access to capital and educational resources. Fifth Third Bank, in collaboration with the National Community Reinvestment Coalition, made a commitment to invest $32 billion into the communities that we serve through 2020. We have exceeded our commitment with significant help and engagement with community and business partner organizations such as Accion Opportunity Fund. As you can see from the slide, we've completed the 5-year plan with $41.6 billion in lending and investments to improve lives in low and moderate income communities throughout our 10-state footprint. We've committed $16.3 billion in mortgage lending, $12.6 billion in small business lending, and $11.4 billion in community development lending and investments. Fifth Third Bank is committed to all of the markets that we serve. Several hundred entrepreneurs have already been helped through our support of economic development programs, including technical assistance and micro lending for small businesses through partners like Accion Opportunity Fund. If you're launching your business or expanding it, our team at Fifth Third and our resources are available to you every step of the way. Please visit our Business Resource Center at 53.com and let us help you meet your financial goals and assist you with smart financial solutions for both your personal and business needs. Thank you so much, and back to you, Gretchen.
Thanks, Philip. And now we'll get started with our discussion. I'm pleased to introduce our panelists. Today's experts include Christopher Schultz from Aprio. Thanks for being here, Christopher.
Hi, everyone. Thank you for having me. It's great to be here.
And I'm also excited to welcome my colleague, Luis Ramos, who serves as Accion Opportunity Fund's Director of Business Advising. So glad to have you with us, Luis.
No, likewise. Glad to be here as well.
In addition, we're pleased to welcome Scott Miller from Fifth Third Bank to today's discussion. Hi there, Scott.
Hi, Gretchen. Welcome, everybody.
Great. let's go ahead and get our conversation started now. First, I'm going to turn things over to Luis for a brief overview. Luis?
Thanks, Gretchen. Welcome, everyone. So in today's webinar, we're going to be talking a little bit more along just getting a better understanding as far as what financial statements you should be looking into, making sure you have under your belt, right? So we're going to be talking about our profit and loss statement, the balance sheet, and a cash flow statement. So with each one of these financial statements, they're very important for any small business, especially if you're in the early stages, and even more importantly, as you're growing your business later on down the line. And you really want to get a strong understanding as far as how these financial statements specifically each affect a certain part of your business in different ways, right? So first, we're going to be talking about our profit and loss statement. So we can go to the next slide, please. And the profit and loss statement, what it really does is the way that I see it is it's more like your journey. It represents your business's journey over a period of time. So this just really tells everything that's happening within your business from a monetary perspective. So you'll see every single sale that you've made. You'll see every single expense that have been spent on behalf of the business, and it'll all be reflected in a single document. So it really just kind of highlights the ups and the downs of your business within a period of time. Usually most profit and loss statements, also called an income statement, tend to be generated within a calendar year. So most businesses decide to have their income statement from the beginning of January, and they typically end at the end of December. It just really depends on what your fiscal year looks like, right? What day does that year begin, right? So that's really up to you. But for the most part, a lot of businesses will have just kind of like this document that just highlights everything that's happening within their actual business, right? So a profit and loss statement can be broken down into different categories. So if you look at the slide here, we first have kind of like our first 3 rows. What this really just highlights is kind of like really the sales that your business is doing and the costs associated with those sales as well. So your revenues could also be just kind of like deciphered or interpreted as your overall sales for a calendar year in this case, right? In this example that we have here. And associated with those sales obviously are kind of like the cost of goods sold. And what that really means is what did it cost your business to make those products, right? So if you are a restaurant and you sell pizza, right? What is the cost of those materials, right? What is the cost of the dough, of the pepperoni, of the cheese, even the box itself that you're using for delivery, right? What does it cost for you to physically make a product and sell it to your customer, right? So these are also called direct costs or variable costs for your business, and just really just highlight exactly, the cost of you selling a product. Outside of that, then we also get into operational expenses. And these are expenses that every business will run into. And the best way that I can describe them is if your business, like even if you don't make a single sale within a day or even a month, right? There are still certain things that you have to pay in order to be in business, right? So if you have a location, if you have a brick and mortar location, you know what, you can't tell your landlord, hey, you know what, I can't pay rent because I didn't make a single sale, right? Or you can't tell your insurance company that, you can't pay them because you didn't make a single sale. So these are the costs that are going to happen regardless of whether you make a sale or not, right? So these are things like rent, salaries for your employees, supplies, supplies outside of your products, right? So it could be like, buying office equipment, office supplies, envelopes, things that are outside of your product, advertising, utilities. So just kind of like the things that you need to pay in order to maintain your operations on a day-to-day basis, right? So you really need to have these things in order to function, right? So these are your operational expenses. And ideally, what's going to end up happening is that as you make sales with your business, you're going to make enough money not only cover the cost of making that product, but also cover the cost of all of your operational expenses, right? And that really leads us to kind of like the last line here, which is going to be your net income or loss. So at the end of the year, you're either going to have a profit or a loss, right? And your books will say, hey, this year we made X number of dollars, or we lost X number of dollars, right? And that's really how this works, right? So as you work with any lender, especially in if you're trying to get financing for your business, what a lot of lenders want to see is they want to see a good number on here, right? Yeah, there's a couple of other add backs that they can kind of like add to kind of like make you like qualify for that loan a lot easier. But overall, the most important thing to learn, at least from here, from the brief time that we have here today, is that the more money that you can demonstrate that you're making usually means that you're more successful. And that usually implies that you're running a successful business that is growing, that is making money, that is eligible for financing down the line, right? What that financing look like really just depends on a variety of different factors, but that's just kind of like the gist of it, right? Just kind of get a better understanding. So as we move forward as well, if we can go to the next slide, there are a couple of calculations that are going to be very important for you as a business owner to really kind of get a better handle on. So from our previous example, one of the first calculations that I always tell a lot of clients that I'm working with is just to kind of understand what your sales growth look like over a period of time, right? So we have the sales growth calculation, and this can be derived from your income statement over a period of time as well. So the sales growth formula just really indicates whether sales increase or decrease over a period of time. And this calculation could really help you measure the growth of either a new initiative or a new product, a new marketing campaign, whatever it may be, right? The best way to calculate this is if you have, you can do this on a yearly basis. You can do this on a monthly calculation or even a weekly calculation. It's really up to you. But the way how you do this is you get your recent period sales and you subtract them from your previous period sales as well. So this could be your sales from this month, comparing them to last month's sales. This could be this year, comparing them to last year's sales, right? And you divide that by the previous period sales, and then you multiply it by 100. And what's going to end up happening, what's going to come of this is that it's going to give you a percentage. And what that percentage really means is it kind of like helps you as an entrepreneur better understand, all right, from month to month or from year to year, my sales grew by about 10.5% in this example, as listed here as well. So by this, you can get a better understanding of like, hey, is it worth me spending this much money on a Facebook ad or an Instagram ad? Or is it worth me devoting resources to develop a new product line, right? And you can do different tests, you can implement the campaign. And then with this calculation, you can figure out exactly, hey, did this make sense for me as a business owner? Is this growth for example, in this case, the 10.5%, was it worth me investing X number of dollars into something to get a 10% growth in my sales? And that'll vary from client to client, right? Some will say that's a great increase, right? I'm happy with that. And others would say it's not worth it. That wasn't as high as I intended or as I expected. And you can analyze it from there, right? So I always encourage a lot of clients to really just kind of like use this calculation to kind of measure the growth or the value of new initiatives, new products, new marketing campaign, so they can come back and really just analyze whether this was worth it for their business as well, right? So this is a great calculation that you can implement, and you can tie it to your P&L really closely, and it can tell you a lot of information to kind of like further go into your business. So that's the one. And if we can go to the next slide, please. The next calculation that we have is what we call the net profit calculation, right? So this will happen naturally as you create your profit and loss statement, because what you want to get at the end of the day is the bottom line, right? You want to understand what your net profit looks like within a calendar year. So what a net profit just really tells us is a couple of different things. So as I mentioned earlier, it really just tells you whether you're running a profitable business, right? It tells you how much money your business ended up ultimately pocketing at the end of the year. And this is money that you can then reinvest into the business to continue to grow that business. You could maybe like modernize your space a little bit more. It could be a down payment for like a second location. It could be used as like a way to kind of like attain additional financing and leverage that money. Or, I've seen other entrepreneurs that'll say, you know what, I did great and I'm going to pocket this money because it's kind of like my reward, right? So you can do a lot of things with this kind of like bottom line, right? So it's really just better understanding, at least from an entrepreneur's perspective, how successful were you in managing that business, right? And more importantly, being able to kind of look at this number and say, you know what, I could have done this, I could have done better, right? Or you know what, I could have done worse. And really understanding like, I only made 25,000. What can I do to either reduce the cost of operating my business, reduce the cost of my materials needed to make my product. Or this could be like a big tail really telling you, you know what, last year I made 30K, this year I made 25K. I'm losing money. Why is that, right? Maybe it's time that you increase the price of your products, different things, right? So it really helps you better understand the overall state and health of your business. So this is a great calculation just to look at overall. Can we go to the next slide, please? And finally, we also have what we call the net profit margin. And what this really does, it indicates the percentage of profit for every dollar of revenue, right? This is also another great tool to kind of like better put in perspective as far as what is the value that's going into your business, right? So the way that you calculate this is you get your net profit, right? So the money that you made at the end of the year, right? This is kind of like the money that you can either bring home, it's sitting in your bank account, it's just, this is the profit that you made. And then you divide that by your sales or your revenue in this case, right? And then you multiply that by 100. And this is going to give you a certain percentage, right? So what this percentage really tells you, so in this example, it's about 23.8%. What this tells you as a business owner is that every time that I make a sale, or every time that I'm bringing in a dollar, every time that I make a sale or I'm investing into my business, every time that I spend $1 or I get $1, 23.8% of that is going to be profit, right? I invest $1,000, I can expect at least to get 23 cents of that to be pure profit at the end of the year or at the end of that sale, right? So this really helps you better understand exactly how far your dollar is reaching, right? Compared to your sales, right? Every time I make a sale, from every dollar, 23 cents of that is profit, right? You can play around with that number as well, right? You can increase that percentage, you can decrease that percentage. And it's really just manipulating either your sales volume, either being able to sell more overall, or by increasing your prices. So all of these things will really just kind of help manipulate that number. But as a business owner, it really helps you get a better perspective as far as how much money can I expect from like every dollar of sales that I'm making, right? From like every single sale. So this is a great calculation to also do, but overall, these are all the different things that you can learn from having a P&L statement in your business. Next slide, please.
Okay, great. Thank you so much for sharing those calculations, Luis. And now I'd like to bring Christopher into the conversation to talk even more insights that business owners can glean from the profit and loss statement. Christopher?
Thank you very much. Thank you, Gretchen, and thank you, Luis, for the the great lead up to this. So what I'm very excited about and to share with the audience today is the fact that you have some tools at your disposal out there that the largest enterprises in the world are using at a very, very low, reasonable cost. And I'm talking about business analytics software, specifically data visualization tools. And these images you see here are, this is one called a product called Tableau. Another one by Microsoft is called Power BI. These cost as little as several $100s a year per individual. So what's exciting for me is that now individual business owners and employees for small businesses can tap into their accounting systems. In a lot of cases, a lot of our clients are working with QuickBooks and QuickBooks Online, for example. Another popular software platform for accounting is Xero, and there's many others that have joined Quicken and QuickBooks Online and some of the other platforms that have been around for a while. But what's great about this is that we can now tap into that GL, tap into your accounting data, and start to drill in. And what Luis was sharing, the calculations which were crucial to understanding profitability and performance. Those are not things that you have to do by hand or in Excel. We can tap into the software, load it into a product like the one you see on the screen. And we can not just look at it at a single point in time, but look at how these measures, these profit ratios or margin calculations appear over time. And also, how do you measure those by individual products or services that you have? how do certain customers perform in terms of both the revenue and profitability and margin, and how are those changing over time. So what's great here is once you can get access to that data, that information from your accounting systems, the possibilities are endless. And having this data and information at your fingertips will allow you to drive change. And I'll give you a couple of examples. But first and foremost, point number one, your general ledger, I've worked with clients before where they have very summarized GL. So you can produce your financial statements, you can produce the profit and loss statement, you can produce cash flow statements, and you could produce your balance sheet, and you can get some basic reports out of your accounting software on those statements. But sometimes they say, well, I need to look at this by a project because I'm a construction company and I look at everything by a project, or I'm a consulting company like Aprio. We like to look at revenue and margin and profit by individual projects. So in order to do that, our accounting software, our chart of accounts and GL have to be set up so that those codes, those entries for either a project number or a customer or location are part of our accounting system. I think that's a crucial detail that we have to make sure that whether we're setting it up or we're having a CPA set up, that they understand, and most likely a CPA will understand that there's downstream ramifications of how you set up that chart of accounts, namely how deep of analysis can we do for on customers and products and locations. So once you do have that information, we start to ask questions, right? So the first thing I like to do is make sure that we are understanding where we are. If we're comparing our current year to date, well, how are we performing on for our revenue, for our income, compared to the plan? So what did we budget, or what do we plan for 2021, and how are our actual? So what we're performing there is a variance analysis. Getting the budget or plan information into your analytical tool, in this case, it's a data visualization tool, along with your actuals data, will allow you to drill into information to try to see when things are off. Well, why is that? You can start to ask questions around, are there certain products, are there certain locations that have been underperforming compared to plan? And we can start to drill down and ask those questions and get those answers. So what are those outliers, and what's driving those outliers for either certain products, divisions, or regions? Other questions, right? So when we start talking about customers, which customers are most profitable? What are your key accounts? So this software would allow you to drill into those details. What products are your key customers and your top customers purchasing? And what's the different product mix or service mix that they're purchasing from you, and how has that been changing over time? So on the bottom visualization, I have basically just a chart that shows me the top performing customers. I can sort that by revenue, by margin percent, and by the growth or change from the previous year or another period in time. I'm also looking at the trend and how those customers perform over time. I'm also looking beyond just the top customers, because sometimes we have very large accounts that have been longtime customers. There's not much growth there. So we're looking to grow our business. There could be some smaller accounts who are driving most of the growth. Double, triple-digit growth from previous periods. And so we also want to look into those details as well. What's great about the software, my favorite thing, is once we start looking at this summary data, we can actually click and drill and get to the most granular transactions. So I think one thing that's key here, when you start setting up these reporting and analytics solutions, is to make sure you have the finest grain, the most transactional detail possible in here. When I first started working in this field 20 years ago, both the computing power that was on our machines, geez, that was so long ago, I don't remember even having a laptop, but that's funny. But basically, we could not crunch all of the detailed transactions on an individual laptop or PC. That has changed dramatically. I can load as much transactions as I have into my software. and I don't have to summarize, and I have all the details there. I can summarize in the visualization, but click through to the details. So I think that's very important. And when we start talking about products as well, so which products or services have your best or worst margins and profitability, and how does that look across different regions that you're selling to, and also across a different mix of customers that you're selling to. And so look at those for the current periods, but also look into how those are changing over time. So yeah, I think that's it. But essentially, again, I think we're in a new age now where we have very powerful analytic tools. Another great thing about the software is that a lot of the how-tos and how you get started and how you set these up, it's available. I had a new employee start and they got on a project and they were already out on YouTube learning some of these software tools that we were providing to them to do some of the project work. They didn't have to go out and buy a book or take an expensive training course. The content is out there on a number of different sites, including YouTube. Okay. Next slide, please.
Okay, great. Thank you so much, Christopher. So now let's move on to the second financial statement we'll discuss today, which is the balance sheet. Luis, what's important to know about the balance sheet?
Thanks, Gretchen. So with the balance sheet, so the best way that I kind of like, and I think before I say that, I'll definitely kind of like say thanks to Christopher. I think having a way to automate a lot of these financial statements at a click of a button and saving you time is very key. You really want to get a better, like a really solid understanding of what's happening within your business, right? Because a lot of people just tend to kind of like just be really like tunnel visioned as far as like the day-to-day stuff. And they really miss out on the overall picture of what's happening to their business and whether their business is like growing or it's declining. And unfortunately, a lot of people tend to react very slowly to these changes, right? And they wait until the very last minute until they have to act, right? So being on top of it with these tools is super important. So with the balance sheet, the big thing to like really understand here is, well, if you look at a profit and loss statement, that's really kind of like, as I mentioned, kind of like the journey, right? It's really understanding everything that's happened to your business within a year's period of time, usually, right? With a balance sheet, what you're really looking at, it's more along the lines of, the best way I can describe it is kind of like a picture, right? So it's taking a picture of your business within a certain date at a certain time. And what the balance sheet really tells you as a business owner is kind of like really understanding where the value lies within the actual business, right? So a balance sheet is really divided into two different columns. So you have your assets and you're balancing that against your liabilities and your equity, right? And the reason it's called a balance sheet is that, well, at the end, as soon as you finish the statement, it should balance out, right? So your total assets will always equal your liability and your equity. So I'll just give a quick example as far as how that really works, just to kind of get a better understanding for you guys as well. So let's say that you are a restaurant owner and let's say that you purchase a new oven, right, for your business. So how would you track that in a balance sheet, right? Let's say that you pay $20K down cash. Let's say it costs $40,000 and you borrow $20,000 in order to finance that, right? So under your asset, well, you bought an oven, it belongs to you, right? So it's worth $40,000. So you would put $40,000 and it's your oven and it'll be a long-term asset. And in your liabilities, well, in order for you to get this oven, you had to go to the bank and you had to borrow $20,000. So you would put $20,000 in the liability section, right? And under the owner's equity side, well, let's say that you invested $20K of your own money as a down payment into that asset, right? So if you had the $20K in liabilities plus the $20K in owner's equity that you invested into the business, it'll equal $40,000, which equals to the $40,000 in the assets line. So it should balance out. And that's how a balance sheet will work. And that's like the best way to explain a balance sheet, right? So that's really what that means. Next slide, please. So there are a couple of calculations that are super important with a balance sheet, just because it really just tells you whether your business is either asset heavy or liability heavy, and really kind of where the money is currently in your business, right? So the first calculation that I have is what we call a cash ratio calculation. And it is a ratio to just really get a better understanding of your company's ability to meet short-term liabilities, right? So what you end up doing is you end up getting your current assets, right? So your cash and your cash equivalents, right? Then when you get sitting in your checking account, kind of like the things that you can turn into cash within a calendar year, right? That's really short term. And then you divide it by your current liability. So it's the money that you currently owe to someone that you got to pay like pretty soon, right? And when you multiply that by 100, you get a cash ratio, right? So in this example, in Paul's guitar shop, we have $32,000 in current or cash and cash equivalents, but he owes currently about 50K, right? So we get a cash ratio of about 0.65, right? What that really tells us, what this ratio really tells us is, so any number that's under 1 really tells us that the business currently doesn't have enough money to satisfy all of its debts, right? So he only has 32K, he owes about 50K that he has to pay back. There isn't enough money to pay that back, right? So that's one thing. If it was perfectly balanced, 101, it really means that he has enough money to cover all of his obligations, right? If that number is greater than 1, if that ratio is greater than 1, that really tells us that the business has more than enough money to cover all of its obligations and then some, right? The reason this ratio is really important is that it really helps you get a better understanding of where the money lies, right? Just because Paul doesn't have enough money currently as far as cash isn't necessarily a bad thing, right? It could mean that he could be spending his money to invest in additional product. It could mean that maybe he doesn't offer credit lines, so he's getting paid pretty quickly. It could be the signs of a healthy growing business, right, as well. And at the same time, contrary, you may think, oh, well, if I have more cash than I do have the liabilities, that means that I'm doing great. And yeah, that's true, right? Because you can cover all of your current expenses and your current liabilities. But at the same time is maybe you have too much money sitting in your bank account that you could be spending it somewhere else, right? So a lot of individuals, you could be using that money to invest in new products, invest in marketing, invest in tools or abilities or even new products to continue to grow that business even further, right? So it could be a way to kind of leverage a new loan, a new line of credit. You could do more with that, right? So it really just kind of helps your business better understand where the money is, right? How much money do you owe, and whether you're in a position to either attain financing, apply for more financing, fix your current pricing, stuff like that. Next slide, please. And then another great important calculation from a balance sheet is what we call the net worth versus debt. So what net worth really represents, it's really just kind of like understanding what kind of equity you currently have in the business, right? And it is also known as the book value of the business. And this is really kind of like how much, like really what your business is currently worth, right? From like a book perspective. This doesn't take into account like, the value of your branding. It doesn't take into account the value of like, the clientele that you've fostered over the course of years that you've been operating your business. It just gives you a better understanding as far as like from like a book value. If I just wanted to sell my business, this is what it's worth on paper, right? Sure, you're going to be selling it for a lot more just because there's more value in the business that isn't reflected solely from like the bookkeeping side, but at least to get a better understanding as far as like, if I were to sell the business right now, this is the book value of that business. So if someone's just offering me $21,000, I would probably reject that deal just because it's probably worth a lot more than that, right? So this is just kind of like a better understanding to kind of like better guess that value of that business from the book perspective, right? And it's just really just understanding what your total assets look like and comparing that to your liabilities, right? Which is going to give you like your equity or the value that you yourself as a business owner have put into that business as well, right? So it's a great calculation to also kind of master and get a better understanding of as well. Next slide, please.
Great. Thank you, Luis. Scott, I'd love to get your thoughts on the importance and utility of the balance sheet based on your experience with small business owners.
Thank you very much. So the balance sheet is a snapshot in time, which is what Luis was explaining. With the snapshot in time, the balance sheet yesterday or a week ago is not the balance sheet of today or tomorrow. So because you're pulling the information and you're looking at your cash will change, it's an actual snapshot of that. So understanding your balance sheet is of utmost importance to whether it's an investor that you're going to be bringing on or whether it's a bank that you're looking to borrow from. Understanding the balance sheet is going to be something that you're going to want to study, you're going to want to understand, and you're going to want to have insight, because as with an X-ray may show a break, but there may be a story behind the break. So the balance sheet is one of those tools that you can use to go ahead and elaborate on with explaining the story. So when I look at financial situations for clients, there's terminology called the 5 C's of credit. And the 5 C's of credit match up very well with the income statements and the balance sheet. So discussing the balance sheet inside the 5 C's of credit, we have to remember that the balance sheet's going to show assets. That's money that you own. So that's, you know, a hard asset, whether it's property, whether it's equipment, whether it's inventory, cash. You know, assets are the items that you own. The liabilities is what you owe others. And then the owner equity is how much you've actually put inside the business or how much you've actually taken out. So from a credit standpoint, when I look at the balance sheet matching up with the 5 C's of credit, which the 5 C's of credit are character, capacity, capital, collateral, and conditions. So how does a banker match up the balance sheet with the 5 C's of credit? The first being character. Character and the balance sheet go hand in hand. Is the information, as Lewis mentioned, is it balanced? Is it showing that it's actually balanced? The biggest mistake I see is an unbalanced balance sheet. That is a condition for a red flag that you don't understand your business, or you don't have the ability to be able to explain your business to an investor or to a bank. So the balance sheet with the character, that matches up. It's your moral compass. It also provides, because we can see how many assets and liabilities you have, that shows into the character. Are you someone that likes to borrow too much money without having enough assets to possibly pay back? So the next part of the 5 C's is capacity. And the capacity is, as we've gone through some of those ratios, one of the easiest ratios that I look at when I receive a balance sheet is the quick ratio. Do you have enough current assets to pay your current liabilities? So we want to see at least a 1-to-1 ratio, because if you don't have enough assets to pay the current liabilities, you either have to borrow money or you have to sell one of those assets that you're listing on the balance sheet. The next 5 of the 5 C's that match up with the balance sheet is the capital. The balance sheet's going to show the capital that is inside the company, the assets, the cash, the receivables, the inventory, you know, what's inside that. Then we look at the collateral. The collateral is very important to banks. Many banks don't do unsecured lines of credit or unsecured lending. They want to see that you actually have collateral. So the balance sheet, you know, it's going to show the hard assets, whether it would be that equipment, whether it be the cash, or whether it be inventory or receivables. You know, those are items that the bank would like to see as collateral. And then the last of the 5 C's is conditions, which conditions are the bank's way of looking at what are actual covenants. A covenant is something that's written with inside of a contract for a loan that would basically allow you to go ahead and have to meet certain metrics. And by us looking at the balance sheet, we can determine, you know, what metrics or what covenants we may be putting on the actual balance sheet. So it's extremely important to, you know, make sure you understand your balance sheet. A balance sheet, once again, it's a moment in time. So you, as the owner of the business or the controller of a business, you need to be able to explain maybe the differences between a project that you're working on and how that's going to affect your balance sheet, or maybe there is an asset that's going to be sold or an asset that's going to be retired and you're replacing to look at that asset. So although the balance sheet's a phenomenal tool, you really need to be confident in the understanding the numbers and being able to portray those numbers to your investors and to your banker. Back to the character part of that, it's very important that we don't hear a lot of him and haws. Nobody seems to be very confident when there's a lot of him and haws. So the him and haws, if you can get rid of and have a true understanding of your balance sheet, that's going to bring confidence to the lender or to the investor that you're the right company to invest in. That's it, Gretchen.
Great. Thank you. Thank you so much, Scott. Okay, our last financial document for discussion today is the cash flow statement. Luis, can you walk us through the key features of a cash flow statement?
Sure thing. And I like to definitely say thanks to Scott as well. It's so very true as far as from a lender's perspective. It's so important to know your numbers before you even approach a lender, just because, as he mentioned, I've been in many meetings where I've seen clients say and ha all the time, or just asking them a flat question, sorry, like, how much did your business grow, or how much money did you make at the end of the year, right? And not knowing that information immediately raises a lot of red flags that really just say, this person isn't here prepared, right? And that's something that you definitely want to avoid. So with a cash flow statement, what we're really looking at here is, I guess the best way that I can describe it is, I usually compare it to like a glass of water, right? And it's a glass of water that fills up and empties out like a reservoir, right? At the end of a certain period. Usually a cash flow statement is compiled on a month-to-month basis, and it really just shows the ins and outs of just money moving through your business, right? So what a cash flow statement is really good at is also identifying the seasonality within a business, understanding lean times, understanding the really profitable times within a business, and really just showing how the money or your checking account is really just growing over time, right? And decreasing over time as you have business expenses naturally, right? So it kind of just compares the inflow and outflow of cash within your business on a month-to-month basis. It highlights all of the cash receipts, the money coming in and the money coming out, right? So the best way that I can best describe it is kind of like as a glass of water that's always going up and down, just depending on whether you're drinking water, drinking a lot of water, running out of that cash, or if you're filling it up during a certain period of time for your business as well. Next slide, please. So what a cash flow statement really does for your business, more importantly, is to kind of like identify kind of like the immediate changes within your business within a period of time, right? So it helps you as a business owner better understand whether your money is increasing or it's decreasing, right? I always advise a lot of business owners to create a cash flow statement because I want them to be on top of their business, right? Really understanding whether the cost of your supplies are going up, right? Really understand whether you need to raise prices, right? Is your bank account increasing over time or is it decreasing over time, right? Because if it is decreasing as a business owner, you really want to understand why is it decreasing, right? Are certain materials that you're using more expensive now? Did your rent go up because you renegotiated your lease at a higher rate? It maybe your business is just, maybe your marketing isn't effective at the moment, or you're running out of clients, right? So, or it could be that you hired more people, stuff like that, right? So as a business owner, you really want to start identifying what your business is doing from a month-to-month perspective, and really understanding whether is my cash increasing or is it decreasing? Because if it is decreasing, that's a great sign, right? And maybe you can help it increase more. Or if you compare it from like a year ago, like let's say that you compare your same business and you look at your bank statement a year ago, you look at last year in July, and you see that your checking account is a lot lower, right? You really want to understand why, right? Why is it increasing, or has it decreased over time, right? Because what you want to do is you want to be able to immediately react to some of these changes and really identify whether there are certain things that you have to do within your business to either change behavior or change certain aspects so that you can continue to be in business for the long run, right? You want to get rid of like things that may not be selling, cut certain costs, etc., right? Or it could be that you need working capital as well. And it's going to be a lot easier to apply for working capital when you're not in a situation where you're incredibly desperate, but rather in a position where you're noticing changes and you're noticing, hey, you know what? I need working capital because this certain aspect isn't working and maybe I need to make a pivot or something like that, right? So it's incredibly important. So it helps you identify working capital needs, It helps you better understand the seasonality within your business and compare it to previous periods as well, right? Whether you're growing and or like shrinking because of seasonality, and being able to compare it over a couple of years period of time, right? And more importantly, it helps you diagnose the current state of the business as well. It helps you better understand all of your costs, all of the money coming in, whether your business is feasible still, right? Because being in business, it's constantly changing, right? There will come a point that you have to increase prices, or you have to, decrease your staff, but this is all very natural, right? But being able to do that, being able to be in control is going to be more important rather than reacting to changes within your business whenever you're in a period where you have to make changes because you're running out of money, right? And more importantly, it increases the profitability by identifying excess cash periods as well. You can use a cash flow statement to really say, like, this is going to be the month where I make the most money. So what can I do with this excess money? What can I do to continue to be more profitable as well? Or even say, I'm about to get to my profitable period, right? Maybe I should borrow some money so that I can even buy more inventory, so I can make additional sales as well on top of that as well. So a cash flow statement overall is an incredibly useful tool, because ultimately what really kills businesses at the end of it really is just that a lot of them tend to run out of cash, right? And if you're on top of this information before you get to that point where you do run out of cash, right? It's a lot easier to adapt and make changes rather than, let's say, go to a bank when you can say, hey, I really need this money to survive, but I don't have any more assets, or I don't have any more cash in my bank account. And it makes it really hard to get it's really hard to get a loan at that point in time, right? Next slide, please.
Okay, great. Thanks, Luis. Let's talk some more about how important cash flow statements are to a business. Scott, I know you have some great insights here.
Thank you very much. So for those that see the picture on the screen there, we've got a couple of cavemen pulling a wagon full of rocks with square wheels, while someone is behind them holding two wheels, and the one individual says no thanks, and the other individual says we're too busy. So this sums up, in my experience, what a lot of business owners find themselves. They feel that they're pulling that rock on square wheels versus a round wheel. So many businesses, it's not that they have bad ideas, it's that they don't manage the cash. So as the statement says, why does booming businesses still fail? And booming businesses still fail because they run out of cash. So having a cash flow statement, or managing your cash flow in general, is a great tool for you to know if you're able to cover short term and if you're able to be there for long term. So when we look at as a bank, we want to make sure that your cash flow can cover the short term. So can you pay your employees? Can you pay your suppliers? Are you going to be running behind, or are you going to be having to borrow additional money, whether it's you injecting capital into the business yourself, or maybe you already have a line of credit, or you have another lending source out there where you're going to be putting money into the actual business. Now, that's not always a bad thing, because a lot of businesses are peaks and valleys. You go up, you go down. So having the cash flow statement helps you plan for those peaks and valleys. You want to make sure that by managing your cash flow and looking at your cash flow, that if you're a Christmas tree farm, that you are going to have peaks and valleys. You're going to be very busy part of the year, and you're going to be unbusy some of the year. So, having the cash flow statement gives you a great understanding of the money moving in and the money moving out of your actual business. So from a bank standpoint, there's a terminology called a 13-week cash flow, which basically analyzes the next 13 weeks. And that can be very important because you get through a couple of different cycles inside that 13 weeks. So using the cash flow statements and utilizing and understanding your cash flow is extremely important. One of the conversations that I have a lot of my clients is cash flow is an art. You want to make sure that you are taking advantage of different situations. So if you have an abundance of cash, and maybe you are making interest on that cash, or maybe you're not making interest on that cash, should you be utilizing that to maybe pay a vendor that's offering a discount? Or should you be paying some debt down that you might have? So, the art is balancing your cash, making sure that you're utilizing it in the right areas of your business so that you can be successful. Because back to the beginning there are a lot of successful businesses. It's not that they have bad ideas, it's that the business owner didn't take the time to sit back and manage their cash. So from a lender standpoint, this goes back to the hem and haws. You want to understand your cash flow. You want to be able to go in confidently and knowing that you have the cash flow to not only cover short-term, but the long-term cycles of your actual business. Back to you, Gretchen.
Great. Thank you so much, Scott. And Christopher, could you share a bit more about some methods for learning even more about the business through cash flow analysis?
Absolutely. And I believe we have a hard stop at 2, so I'm going to move quickly through this so we have time for questions, Q&A. Again, I mentioned dashboards and the profitability section. And once we have the right tools and we're able to connect our transactional data, our financial data to our dashboards, there's some really cool things we could do with cash flow analysis that allows us to answer several questions. What's our, how long is our, how long are we carrying inventory? What's our days in inventory if we're carrying inventory for cost of goods sold? How often are we being paid? There's a number of different, there's a day sales outstanding ratio that we can start looking at to see how often we are collecting payment. And we can start to also measure how quickly our days payable outstanding, how quickly are we paying suppliers. I think what I'm getting at here is that it's important to understand our cash flow cycle. And that is when we make a sale for a product or service, what is that period of time from the point of sale to the actual payment, right? Because within that time frame, we're going to be paying suppliers for cost of goods sold or the cost to deliver the service. If we have an inventory, there's a cost of having that inventory. So there's a number of days period for the inventory that we're going to deliver. And then there's the time it takes to, once we invoice our customers, there's that time it takes, that time in receivables that before we get paid, which is your days sales outstanding. So these, the time periods here all have implications for your working capital usage and your cash flow. And so once we start having some analytics capabilities in this area, we can start to understand, how often are we paying, what's our average time to pay our suppliers? Are we paying suppliers earlier than the norm? And if so, are we taking advantage of early payment discounts? Suppliers, especially suppliers that need the cash for themselves, often offer early payment terms. And so why aren't we taking advantage of that? So that's one thing I think coming out of this is to understand how often you're paying your suppliers, and if you're paying them early or before they're actually due, are we taking advantage of early payment? Because right there is an example to improve working capital by taking advantage of those discounts. And on the flip side, the days sales outstanding, how often are we collecting payment from our customers from the time of the invoicing? And so are there large accounts? I mentioned profitability, and now we're getting into, are some of those key accounts, are we collecting that those receivables on time in terms of what we're expecting to for that that cash cycle. Another thing that's really great about cash flow analysis is being able to connect right to your bank statements, bring in all of your debits and credits, and visualize over time that seasonality, but also on a weekly or even daily basis, how is my cash, what is the effect of my transactions for my business money coming in and out on my cash flow. And we can actually really create some really neat visuals in this type of software. And the software also allows you, if you have multiple bank accounts, it will allow you to, there's a little bit of work that has to go into it, but it will allow you to combine accounts so you can see the cash flow activity across your multiple bank accounts. I'm going to leave it at that now just because we're getting close to the end here and I want to make sure that we have time for Q&A.
Okay, great. Thanks so much, Christopher, Scott, and Luis. So much valuable expertise and so many insights today. Now, folks, it's time for your questions. So please go ahead and type your questions in the chat box, and I'll be happy to ask them for you. If you have a particular presenter that you have a question for, just you can indicate, the name of the person that you're hoping could address it. So the first question is for Christopher, and it's, once business owners have these documents and tools in place, how should they actually start the process of analyzing the resulting data? Christopher?
Sure. So within these tools, once you make the connection, let's say I'm using the tool, the screenshot that I shared, Tableau, there's connections right into QuickBooks, which is great. So I can actually, as long as I have my QuickBooks online account information, I can actually connect and start seeing and viewing the data. I think some people can dive right in and start connecting and visualizing the data, but I mentioned that it's smart to invest some time on some of the videos and tutorials that are out there. I mentioned YouTube. YouTube is such a great place for just free learning and insight into all sorts of software tools. But for these, Power BI was one I mentioned, Tableau is another one. There's hours and hours and hours of free content out there where you can start learning how to do these things. And if you're trying to do cash flow analysis in one of these tools, you could probably go on YouTube right now and find examples of people and you walking you through that. So I think that's one thing, is to get, invest some time in learning the tools up front, because that's going to pay a lot of dividends later on.
Thank you, Christopher. And the next question is for, I guess the last question that we have time for is for Scott. It's about the 5 C's. And Rudy asks, is one or more of the C's weighted in your formulation for granting credit? Scott, how's the balance of sort of the 5 C's? Are they all equally important?
So throughout the lending cycle, the 5 C's, can change. So when I say that, the upfront character is going to be the most important, because that's going to give a quick determination if the bank or the investor is going to want to spend additional time with you. So if you don't have a good character, or you're not showing that there's a value there, you're not even going to get to the remaining 5 C's. So as the process continues to go through the lending cycle, the 5 C's will have an equal value, but up front, I would have to say that the character is going to be one of those. It's, no difference than going on a first date. If you don't show a good first impression, you're probably not going to get to that second date.
Okay, great. Thank you so much, Scott. And that is all the time we have for today. Thank you to our presenters for sharing their valuable expertise and insights. And thank you to all of our participants for joining the webinar. We will be sending around a recording to all of you in the next few days, so you have that. And in the chat box, I put some links and an email address where you can reach out directly for more information. We hope you feel more prepared to make strong financial decisions for your business as a result of this webinar, and we hope you have a great rest of your day. Thank you, everyone. Take care.